Let's talk about the capital leverage concept that allows you to buy assets that cash flow without spending your own money. In fact, this method transforms the wealth that you have into power in your region or community, as well as additional wealth that kind of stacks on top of it. It's almost an unfair strategy that the elite and the wealthy people have used for centuries. And I'm going to give you a high-level overview of it right now. I'm Justin Hitt with Sustainable Wealth Secrets. The concept here is to use a large deposit in a small regional bank in order to gain influence in the community and acquire assets that cash flow. You're essentially buying the bank. Now, why would you want to own a bank? Well, first off, you can't just own a bank. You have to purchase a bank charter. And by purchasing the bank charter, you are going to have staff and overhead and regulators. And there's a lot of stuff involved. I've known people that own banks. Now, it is profitable to own a bank because there's such a thing called fractional lending. And if you didn't know where banks got the money from to lend, they get the money to lend from deposits. Now, what we're talking about here is you becoming a key role depositor under conditions where you receive back some of your money, not necessarily your money, but the money that you need to buy assets that cash flow. Now, remember, when a bank does fractional lending, they're getting money from a central bank or from a Federal Reserve or from some government program, or they're simply writing quality loans against the deposits in the bank. Now, the mechanism that they use is actually your savings account. So there's a percentage of the savings accounts that they can lend back out, and those contracts or loans pay the interest to the bank, which they then give back to you a minuscule amount. So if you simply deposit $1 million in the bank, you're going to get a fraction of a percent in interest. There is a specific leverage strategy that I'm going to introduce to you here that is necessary so that rather than buying an asset with cash, because that's what a lot of folks want to do, you're going to buy assets with the bank's money. This is incredibly important. So if you have a deposit of $1 million or more, and large is depending on the bank, but I would recommend doing this with $1 million because the math is easier. And if you've got $1 million of deposit, don't tune off. This is something you need to know how it works so that when you do have $1 million in cash, you can do this. But this will quickly multiply your money because you'll be able to acquire assets that cash flow without spending your own money. So a lot of folks that have $1 million in cash say, well, why don't I just buy a property and maybe I'm going to buy a small industrial park and I'm going to lease out the land in the industrial park. That's my cash flow. And I'm just going to pay all cash so I don't have to worry about any payments on this particular property. And that tells me somebody doesn't understand that it's the customer who's going to make the payments. See, you need to write that down. It's the customer who makes the payments. You're leveraging your resources in order to acquire something of value, an asset, and you're going to loan that asset over to your customers. So in the case of an industrial park, you're going to do the research to make sure the industrial park's a good idea. You're going to look at rents. You're going to make sure you can make your money back in a certain amount of time. You're going to make sure you have cash flow on the asset. And then you're going to deliver this valuable service to the community, which would be your customers. And they will then pay you rent every month. And yes, you'll have the headaches of not being able to pay rent. But if it's an investment worth your cash, then why not leverage the cash in order to gain influence as well? Now, I'll explain to you what that influence is here in a second, but think about this. If you don't use your cash, you could get a commercial loan. The commercial loan would pay for the property. But if you have cash, why pay interest on your money? The concept we're talking about here is depositing that money into a regional bank. Now, big banks don't want to do this because $1 million is not a lot of money to a big bank. But a regional bank that only has $100 million in revenue or $200 million in revenue, your deposit could be 1% of their revenue, but they're not just going to let you put it in a bank account because the FDIC won't insure it. What you're going to have to do is structure it in certificates of deposits. So banks get the money to loan through long-term certificates of deposits or buying bonds in the bank itself. So a bond is basically a loan to the bank. if the percentage interest of the CD is the same or higher than the mortgage that you take out to purchase the property, you have in effect partnered with the bank to purchase the property, but haven't spent any of your money. Now listen carefully, because a lot of folks are going to say, well, Justin, I put $1 million in the bank. I took out $640,000 to buy a piece of property. The cash flow on the property pays the mortgage. And I spent $640,000 more than I wanted to. You're not thinking about the strategic relationships here. If you have $1 million on deposit in a bank, and I'm just going to use some simple terms, it's not really on deposit because the FDIC will not cover $1 million necessarily. You'll have to get structured. It have to be structured, which could include certificates of deposits. It could include bonds. It could include something with an insurance policy on it. It could include something that per se has 3 to 4% interest. I know you're saying, Justin, if I had $1 million, I'd put it in the stock market and I get more than 3 to 4. Again, this is about leverage. This is about power. This is about multiplying that money in your local community rather than spreading it out into a more complex or risky market. You know, if you put $1 million on Tesla, yes, you might make 20% on your money, but we won't have that local multiplier. So let's talk about that first. Next, you wouldn't have the inside information that you'd receive with the new relationship you've earned with the bank. And finally, you wouldn't have the connections or the flexibility that comes with that money. So first, the deposit. When you make $1 million deposit at a regional or local bank, everybody's going to want to be your friends. Now, make sure they don't know that you have more than $1 million. You always want to divide up your money. We talked about in other places so that when you go for a mortgage, you're not showing them the whole kit and caboodle. If you've got $100 million in savings, it doesn't benefit you for people to know you got $100 million in savings if all you need is $2 million in savings in order to get the loan that you're looking for that buys the asset that cash flows. And if that asset actually pays the debt service, yes, you'll pay a little extra money because you're paying interest to the bank, but it's a local bank, and local money tends to circulate through the community 3 to 9 times. There was a big research study by Virginia Tech that showed that every dollar spent at a local business circulates through the community 3 to 9 times. So you get a multiplier of value. So the asset you're purchasing is that structured relationship with the bank. So I'm going to call that a certificate of deposit. And let's say you put $1 million in on a 4-year certificate of deposit because the bank is going to want to lock that money up because they're going to loan that money out. And you say 4%. Now they might say, well, we don't have a certificate of deposit for 4%. Well, for $1 million, could you write one? See, there's a little bit of attitude you're going to have here because you're buying an asset that cash flows. This asset that cash flow is the certificate of deposit. It cash flows 4%. And you're going to say, Justin, why lose access to the money? I lose the $1 million. Well, listen, if you took the $1 million and bought something in cash, then you still don't have access to the $1 million unless you sell the asset. So what we're doing is we're buying a highly liquid asset, the certificate of deposit. You're getting paid a 4% interest rate. And then that piece of property, remember that industrial park we're talking about? Now, it doesn't have to be an industrial park. It could be a farm. It gives you a tax deduction. It could give you hay and resources that you need to feed animals that you already own. It could be expanding a business that's going to cash flow. It could be a lot of other things. But ultimately, you are buying the first asset, which is the relationship with the bank through a certificate of deposit. And then you're going to take out a loan, not for the whole $1 million, because again, there's fractional lending. You want the bank to make a little bit of money off you. You want the bank to feel that they need you. This is part of the power relationship. And if you're uncomfortable with this part, we can talk about it in coaching. But here's the thing. That bank's going to have $1 million and they're going to lend it out using fractional lending, and they're going to get $5 to $10 million in value out of that money. It is possible they'll contact the Federal Reserve, the regional banking system, some kind of fund that's in their community, and they'll say, look, I got $1 million on deposit for 4 years under a certificate of deposit. It's insured, it's properly managed, and we'd like to borrow against that money in order to make quality loans in the community. So they work with the federal government, the state government, the local government. They get matching funds. So every dollar they take from your account, which you're not going to take the whole million, they might take 500,000. They're going to get matching funds. So now they have $1 million to lend out. They're going to lend it over thousands of different people, which gives them diversity and some protection because all these loans are dischargeable in bankruptcy. Listen carefully, folks. They might even give it out as student loans, though, and then it wouldn't be discharged. They could give it out in mortgages, which they sell the mortgages into the mortgage market, which they get the money back immediately. You've now given the bank a multiplier. Now, I'm using the number of $1 million because it's just an easy math. $1 million at 4% gives you $40,000 a year. As long as you buy the asset on the second turn here, the asset that cash flows that has payments less than $40,000 a year, you have in effect bought the property with cash. The industrial park example, you've bought the property with cash, but you're only tying your cash up for 4 years. See, if it's really an asset that cash flows and it produces $40,000 a year to pay the mortgage, so the loan is covered by service of the asset that produces cash flow, then in effect, and I know this is real dense, folks. I know this is something that you don't hear every day. I know this is something that you're not going to find in a textbook unless you dig deep into a finance textbook or you dig deep into the memoirs of somebody who's actually done this. You're going to find out that after 4 years, you can take your $1 million away. Now, you may not want to do this. You may use the certificate of deposit as some sort of baseline to determine whether the property is working well or not. But essentially, you have the interest from the CD to pay back the mortgage, and you have the cash flow from the property to pay back the mortgage. Can you see if you paid cash for the property, you wouldn't have the interest of the CD to service the property, and you wouldn't have the cash flow of the property going into something that creates equity for you. Essentially, you're now buying the property for the cost of interest on the mortgage. Now, you can pass this by your CPA. I've got diagrams that shows you how to work this. I've got steps to walk through it, but can you see how you actually didn't spend your own money? In fact, you didn't even spend the bank's money. You basically put your money in an asset that cash flows, the certificate of deposit, and you're using the interest to make the payments on a mortgage that's kind of backed by your original money. But the bank isn't going to turn you down for, let's say you deposit $1 million and you take a mortgage for $640,000. The bank isn't going to turn down your $640,000 because they've locked in your $1 million. And if it's a mortgage or a business loan, it is possible, and it's ideal, if the interest on your mortgage is less than the interest on the certificate of deposit. Now, again, they're not going to give you one certificate of deposit for $1 million unless the bank is big enough to do that, because it wouldn't necessarily be insured. There's going to be a contract. It's going to be a little different. So your $1 million is slightly at risk in the bank, but not as much as risk as if you bought a piece of property that's going to be difficult to resell. Property prices go up over time, but they don't go up in the next week or next 4 years. If you buy the property immediately, you don't have that backstop of being able to go to the bank and getting a line of credit or a letter of credit from the bank in order to do the things necessary to make the property maximize cash flow. This is very important. You also don't want to be in a situation where you've spent your $1 million and cannot get it back. So I mentioned earlier that many of these loans are dischargeable in bankruptcy. I am not advocating that you ever file bankruptcy if you have a large amount of money. But what I am saying is that if you structured the asset in an LLC or some kind of corporation and things went really bad, paying full cash for this means you do not get your money back. But if you have it structured properly and things do go bad and you file for bankruptcy, you can then discharge the loan but you still have the $1 million in the bank. Now, your proceedings in the bankruptcy court may take the $1 million. So again, I'm just giving you a concept that you need to talk with your lawyer about, but the backstop is you never spent the money, but you got two assets that cash flow. Now, the piece of property, the industrial park example, may not cash flow for 5, 10, or even 20 years. But again, the underlying value of the asset, if it's properly done, the mortgage will not be greater than the underlying value of the asset. So in all the worst case scenarios, your risk is reduced because you could sell the asset. So again, the risk management strategy on this is something I specialize in, is properly structured. It could be in a business that discharges the loan under bankruptcy or restructures under bankruptcy if there's a problem that you can't pay back the loan. You don't have to withdraw the certificate of deposit to pay back the loan. You can structure it to pay it back. It is also possible that you'll have a delayed cash flow on the asset because of infrastructure costs. And if you pay cash for the property, you've limited the amount of resources you have for the infrastructure costs, and therefore you've created additional risk where you could get halfway through a good project and not be able to get to cash flow. So you're going to build out a pro forma cash flow. You're going to talk over with the bank. You could talk over with other banks too to get second opinions. You can talk over with your CPA, your lawyer, your tax attorney. But ultimately, it's a packaged unit where if you just cut a check for $1 million because it feels good. I had a client who could just cut checks for $1 million, and it felt good to cut the check. And I asked him, why are you paying cash? And I really should give you the origin of the capital leverage concept. It actually came from a farmer in southern Maryland who over the years had saved up some money, and he'd sold some land, and he had a little problem with the bank. So the bank calls him up one day. I'm over at his house. We're working on a couple things. And the bank calls him up, and they're very concerned about the $500,000 he has in a savings account and the $500,000 he has in a checking account. First off, they were concerned that they couldn't spend. Well, let me get to that. That's kind of the punchline of the joke. First, they were concerned that it was not insured by the FDIC. So $500,000 in a checking account back in the 1990s was definitely not insured by the FDIC. So the bank had risk. So they have risk management people. I've been a risk management person for a bank. They go through the accounts and they say, oh my gosh, this guy's got $500,000. If the bank ever had a problem, we're going to be liable for $500,000. If he would suddenly withdraw the $500,000 from his checking or his savings account, then we're going to be in trouble because we fractionally loaned it out. So here's the thing. The bank called him and they are begging him, please either take this money and go to our brokerage branch or take this money and put it in a certificate of deposit, but please don't have $500,000 in the checking account and don't have $500,000 in the savings account. Now, this farmer wanted to have $500,000 in a checking account because he wanted to be able to buy farm equipment by just writing a check. And the bank said to him, well, if you put it in a certificate of deposit, we will give you the money to buy your farm equipment. In fact, we will finance the farm equipment for you. So the long story short is if the money is in the right structure for the bank can leverage that money and give you lines of credit, equipment loans. They can give you mortgages. And I say give you because very often the interest rate on those items is less than the certificate of deposit. They are reserving the money because they need to lock that money up in order to 5 times or 10 times lend it out. Think about this. They might give you an equipment loan for 5 or 10%. Your CD could be at 5%. And you say to them, well, I could just pay cash for this equipment and my interest rate would be 0. And the bank manager is going to be thinking in the back of their head, well, I've already lent all this money out, and if he withdraws this money, I'm not going to have the right ratio with the Federal Reserve, the regional banking system, with whatever program they're using to do the fractional lending. And therefore, the bank is now going to have more risk than they would have if they just put the $500,000 in the bank or the $500,000 in the savings. Now, this particular farmer was quite simple looking, but extremely clever. And there was a glint in his eye as he's saying this. And he kind of put his hand over the phone. He says, son, I'm going to teach you a lesson. And whenever an old farmer says, son, I'm going to teach you a lesson, or an old banker or someone who's got money says, I want to teach you something, you pay close attention and take notes. So again, what he did is the bank says, you got $1 million uninsured in our bank and it's risk for our bank. He made it more risk for the bank by negotiating a terms of agreement that was immutable for both parties. So again, exactly what I'm sharing with you here in a high level concept. There are a little bit of details that you do need to know when you work with these banks, because again, if you deposit $1 million in a national bank, they don't care. They got people depositing $10 million or $100 million. And if you deposit $10 million or $100 million in a regional bank, you're too big of a fish, and they're going to be very scared, or they make bad loans, or they basically get overzealous about the thing. So there is an incremental approach that we can talk about. But ultimately, you might feel like you could just pay cash and it'd be a lot less effort. But this clever farmer simply understood that he didn't need the $1 million. He had a farm that was cash flowing. He had the equipment he needed. But what he wanted to be able to do is to cut a check to buy a piece of equipment, because if a 1945 dump truck fails, and that's one of the things we were talking about, he had a 1945 dump truck, it was getting near end of life, and a new dump truck was going to be $100,000. And then just having a $100,000 dump truck, being an old farmer as he is, he needs a driver for the dump truck. The dump truck was hauling off manure, and then it was bringing back round bales of straw. So he really did need a dump truck. The 1945 dump truck did just fine. It was paid for and everything. And he figured he might pay cash for it. But then again, he didn't want to pay cash for it, because paying cash for a dump truck, in putting a driver in it, isn't just a $100,000 transaction. There's insurance on the vehicle. There's the cost of the driver. There's the fuel in the vehicle. There's a lot of other factors involved when you buy a new vehicle. So, and of course, you could buy a used vehicle, but he's getting up in age, so you didn't want to repair it. So I digress a little bit here. What you have to understand is that your cash is not going to keep up with inflation, and it is not going to multiply your wealth by just sitting in the bank. But he needed to get the attention of the bank in order to find out what options were available. And at the time, he didn't know what options were available, but what he did know how to do is how to negotiate. So what he did was negotiate favorable terms, which is the capital leverage concept that I'm saving here. Now, this podcast is getting a little long. I don't have time to go into the story about the banker that had this in another situation, who tells me how this is ideal for a small regional bank, because that $1 million can become $3 or $4 million in value in the local community. It pays the salaries of the bankers. It pays people's car loans that are, again, much higher interest rate than the certificate deposit. It pays mortgages. It allows people to develop businesses in the community. It is a huge win for your community. But if you're not understanding how the bank gets money to lend, you might go ahead and just pay cash for that industrial park, that heavy piece of equipment, that expansion in your business. Now, again, we're not taking out a mortgage or a loan to put an addition on your house. We're essentially buying assets that cash flow. And originally you wanted to buy one asset that cash flows, and I revealed to you a second asset that cash flows, and now you are able to acquire both assets without spending the original money. See, at the end of all this, you still have $1 million, but you have $1 million in a piece of property that's cash flowing, or you have $1 million in a piece of equipment that's cash flowing, or you have $1 million in something else that cash flows. The cash flow is the key here, because the debt service is going to be paid by the cash flow, and the debt service is going to make it so that you bought the property with the bank's money. Now, of course, your money's on deposit, so the bank is leveraging your money in order to give you new money. And if you didn't know, the banks get incentives to lend out money. So maybe you're buying a piece of farmland, and the bank has an incentive to increase regional farming, and the USDA is giving the bank dollar per dollar the money they lend out for farming. See, it's going to depend on your region. So one of the things I help clients do is, first off, the flow of money. What do we do first, second, third, and fourth? Second, we look at what is the cash flow associated with that flow of money. Are we going to generate enough income in order to cover the debt service? Because you're essentially paying the bank back with your customer's money or the bank's own money. Okay? So, or get the cash flow from the property or the revenue from the certificate of deposit. You have to understand the relationships. There are some banks that are regional banks, and on the outside, they look really good. But once you deposit $1 million into them, banks can go bankrupt, and you don't want them to go into exorbitant salaries. There may be opportunities for a bank where the board members are a little bit up in age, and you could get an opportunity to get access to mentors. And oh man, I could do a 3-day program on this. This also gives you access, and you have to understand this. Having the means but not the influence to change your local environment doesn't support the infrastructure necessary for you to grow wealth. So by doing this, you've invested in a regional bank. The regional bank now has more power to give additional loans. Some of these loans could go to your customers, allowing your customer to afford renting the industrial park space that you've purchased, to buy the products and services that you have, to get involved in something that generates cash flow for you. So you're, in fact, stimulating the economy. But every time that bank repos a piece of equipment, every time that bank forecloses on a farm, forecloses on a piece of property, you're going to be in a position, maybe you're on the board, maybe you're in an advisory group, maybe you're just checking in with the bank every month to see how your money's doing. You're in a position for them to say, oh, by the way, here's the list of the recent foreclosures. Are you interested in any of these properties? See, the bank doesn't want the property. They don't want the assets. All this asset is liability because they're not in a business to hold property. They're not in the business to hold equipment. But if you're in the business and you can cash flow these assets, they would much rather convert the loan or reloan to you, who has $1 million in the bank, than some Joe Schmo on the street that has a high level of risk. This is all about lowering your risk. It's all about lowering the risk of the bank. But it puts you in a position where you can, on demand, increase the risk of the bank by, again, not renewing your CD, withdrawing your money from the bank, otherwise not paying back your mortgage, or moving your mortgage to some other bank by a refinance. You now have power. You now have control. You now become a catalyst for economic development in your region. You're now creating wealth, and you're creating it beyond your bank account, beyond your balance sheet. You're gaining goodwill. You're gaining equity value. Now, if the math is too hard, you're going to miss the upside, because if you have, and I'm using just $1 million because that's an easy number to do the math on, $1 million with a 4% CD is going to give you $40,000 of interest. You buy an asset that cash flows, that has a debt service of less than $40,000. You've essentially bought the asset with the bank's money while retaining liquidity on your own money. If you don't want to do the math, and this is what I help my clients with, we do the math so that you can show it to your CPA, you can show it to your tax advisor. There are tax strategies here that are beyond the scope of what we're discussing. But ultimately, the money is going to lose buying power with inflation, whether you put it in a property or you put it in the bank as a deposit. This farmer was losing money having $1 million in a checking and savings account, but he knew it would get him the bank manager to make a phone call to him. See, previously, when he was poor, he would go to the bank and the bank would tell him no. And so from an ego perspective, he wanted to be able to tell the bank how it is. And this is kind of something we could discuss privately, but ultimately, this farmer was now a key asset to the bank. And the bank wanted to cash flow that asset, so they reach out to him to reduce their risk, because, again, if the bank has problems, they're not going to be able to insure $500,000 in a savings account back in the 1990s or a checking account. The bank introduces ideas to him, so now he has a position of power where the bank is doing all the work, and he's able to describe his needs, because, obviously, if you could just pay cash for something, it's less hassle. But he didn't see it as hassle being invited to the board of the bank, being called by the bank on a monthly basis to be given opportunities to make money, being called by the bank periodically because his neighbor was basically getting ready to sell the property, and they had gone to the bank to talk about the options to sell the property and what it would mean to pay off the mortgage, what's the payoff and everything. And the banker calls over to this gentleman and says, Mr. So-and-so, your neighbor's selling their farm, and you said you were interested in buying additional farmland. Is that something you might be interested in? Now he says yes, and the bank carries the note. So the bank, again, let's say it's a $500,000 property. Sure, you could pay cash for the $500,000, but the bank takes their $300,000 remaining balance on the loan, gets it paid off by you refinancing the property, and now you have access and control over the property as a partner with the bank, and you didn't really spend any money. Folks, this concept is so powerful that I really doubt anybody's going to write it down unless you drill down into finance books. But essentially what we're doing, instead of paying cash, is we're structuring the payments so that you're passing them through a bank who gains value from the money, and then you're basically getting comped the mortgage in order to purchase the asset that cash flows, because you've now zeroed out the risk for the bank. Again, they got your money on deposit, and they're going to loan the money out on a good project, which could be structured as a business. It could be structured as a farm, an agricultural property. It could just be a personal asset. But because they know it cash flows, they've got two ways to repay the loan. So they're going to give you a more favorable rate. This farmer, in fact, I don't know the percentages, but I know the ratio. Basically, this farmer ended up with a certificate of deposit for 4% and a mortgage for 2%. They ended up with an equipment lease for 5%. See, now they can't give you a sweetheart deal that's better than anybody else, because then you couldn't get on the board. This guy is old. He didn't really care about getting on the board, but he wanted his son on the board of the bank. So again, I get really excited about this topic because essentially you're going to get the assets that you want that cash flow. You're not buying RVs with this. You're not buying boats. You're not buying four-wheelers. You're not buying a new pickup truck. You're essentially getting assets that cash flow, eliminating the risk for the bank, and then later down the line, if you need more than $1 million, you simply just go up to the bank, get a line of credit. In another concept we talked about, you can deposit $1 million in a bank, structure it this way, and get $1 million line of credit. Now, again, you're going to pay a little interest on it, but again, that's the investment you're making into the relationship with the bank. That's the investment you're making in the regional community. And guess where you're going to refer all your customers? Let's just wrap up with the industrial park example. Let's say you get the industrial park put together and you're leasing out properties to businesses who have an equipment lease need. Now, of course, you can lend them the money and make it a private loan, but that's a whole different program. But who do you think you're going to refer your good quality, regular rent paying customers so that they can get the equipment to grow their business and be able to afford the additional rent you're going to charge them in the future? You refer them to the regional bank that you have money in. You can sincerely say, look, I've got money in this bank. I think you should have money in this bank. You're going to gain so much goodwill. You're going to gain so much influence. You're going to gain so much control over your own situation, because instead of getting straight interest on your money, instead of getting straight cash flow from the asset, you're now building an ecosystem around the business or the asset that you own so that you insure and lower your own risk. Think about this. If your tenants are getting the loans that they need, you are still earning money off of them because you're getting the interest on your certificate of deposit. Now, again, there isn't a 20 or 30% upside, but there's no risk involved in this kind of concept. If you'd like to talk about this, maybe you have $10 to $20 million in the bank or an overall liquid. If you've got a high net worth and you've got the cash to do this with a regional bank, it can be quite a bit of fun and entertaining. But you don't lose any money because you have debt coverage. We can draw it out on paper. We can show you how the numbers work for your unique situation. It depends on your region. Sometimes the banks are going to be agricultural banks who are going to back up farm loans, which increases your food security. Sometimes they're going to be commercial banks that are going to lend money to the businesses around you, which improves the job opportunities. Maybe you have some kids, you want to make sure they have decent jobs, or say as they start learning about money. But again, it's safer than buying $1 million worth of a bank, being an investor, because they're going to offer that. That's another thing they offer the farmer. They said, look, you can invest $1 million in here, and then we give you an employee discount on your loans. Oh, folks, this is a powerful system. Banks can multiply your money much faster than you can because of the fractional lending. They can leverage your money much quicker than you can, and they can lend it back to you in a favorable rate where essentially you're paying back the money with their own money. If you'd like to talk intensely about this for your unique situation, we can go through the numbers. You can have your CPA or your lawyer on the phone. And by the way, a lot of CPAs that are not high net worth individuals will balk at this. They will say, well, this is not, you're leveraging against a local bank, and that could have sour relationships in the future. No, the banks love this. You can actually even bring your banker on the phone, and we can help the banker understand how they can gain long-term capital assets on their books, which allows them to get access to funding, which again allows them to improve your local community. All this and more. I'm Justin Hitt from Sustainable Wealth Secrets. Visit www.sustainablewealthsecrets.com. Contact me. Ask your questions. Even if you don't have $1 million, ask your questions. I'm more than happy to answer them. But if you have a high net worth, $10, $20 million in the bank, this could be a unique way to get you access to people, get you access to resources, get you access to information, all that would not be available if you just paid cash. Think about it very carefully. Re-listen to this program. I'm here to help high net worth individuals, high income professionals transform their income into wealth and literally put you in a position of financial security where concepts like this, the capital leverage concept, essentially builds up the environment around you so that you get even more money. Now, money isn't everything, folks. That's why strategies like this have value beyond what I've been able to talk about today. But I want to thank you for listening. And again, if you have any questions, visit www.sustainablewealthsecrets.com. Go to the contact page, contact us. I would like you to become a subscriber because we can talk about this in depth as a member of this program. And of course, I got lots more that I could say about this. And if you want to do a 3-day, we could certainly do a 3-day and bring in some peers and really transform your community. Thanks for listening.